When the Federal Reserve announces a rate cut, headlines move fast, but the real impact on your money unfolds more quietly over time. A rate cut means the Fed is lowering the interest rate it charges banks to borrow money. This single decision ripples through mortgages, credit cards, savings accounts, investments, and even job markets. For everyday Americans, the key question isn't what the Fed did, but what it means for household budgets and long-term plans. Understanding how rate cuts work helps you make smarter decisions instead of reacting emotionally to market noise. The Fed typically cuts rates when economic growth slows or inflation begins to ease. Lower rates are designed to encourage borrowing and spending, keeping the economy moving. Businesses can finance expansion more cheaply, and consumers may find loans more affordable. However, this same move can reduce returns on savings. That's why a rate cut creates both winners and losers. The effect on your finances depends heavily on whether you are borrowing, saving, investing, or doing all three at once. For borrowers, a Fed rate cut is usually good news. Interest rates on variable loans, such as credit cards, adjustable rate mortgages, and some personal loans, often decline over time. That can mean lower monthly payments or reduced interest costs. Home buyers may see mortgage rates soften, increasing purchasing power. However, changes are not instant. Banks adjust rates gradually, and lenders may tighten requirements even while rates fall. Timing and credit quality still matter. Credit card users often feel the effects of rate cuts differently. While variable APRs are tied to the Fed rate, credit card companies are slow to pass on savings. Payments may decrease slightly, but balances remain expensive. A rate cut shouldn't be seen as a reason to carry more debt. Instead, it can be an opportunity to pay down balances faster, refinance high-interest debt, or consolidate loans under better terms. For homeowners, rate cuts can open the door to refinancing. If mortgage rates drop enough, refinancing could lower monthly payments or shorten loan terms. However, closing costs and fees must be weighed carefully. Not every rate cut makes refinancing worthwhile. Homeowners should compare long-term savings, not just immediate payment relief. Those with adjustable rate mortgages may see faster benefits, while fixed-rate holders need to evaluate market trends closely. Savers often feel disappointed after a rate cut. Interest earned on savings accounts, money market funds, and certificates of deposit typically declines. That means your cash earns less over time. While this can feel discouraging, it's important to remember that rate cuts are meant to support broader economic stability. Savers may need to reassess where cash is held, and whether liquidity or yield is the priority during lower rate periods. Retirees and fixed-income households face a unique challenge. Lower rates reduce income from conservative investments like bonds and CDs. This can pressure retirees to either accept lower income or take on more risk. Financial planning becomes especially important during rate cut cycles. Diversification, laddered investments, and careful withdrawal strategies can help manage the impact without sacrificing long-term security. Investors often react positively to rate cuts, at least initially. Lower rates can boost stock prices by reducing borrowing costs and increasing future earnings potential. Growth stocks, in particular, tend to benefit. However, market rallies following rate cuts are not guaranteed. Sometimes cuts signal economic weakness, which can weigh on corporate profits. Investors should focus on fundamentals, not just headlines. Bond markets also respond quickly to Fed decisions. When rates fall, existing bonds with higher yields become more valuable, pushing prices up. However, future bond purchases may offer lower returns. This dynamic affects retirement portfolios and pension funds. Understanding bond duration and interest rate sensitivity helps investors avoid surprises during shifting rate environments. Rate cuts can also influence the job market. Cheaper borrowing encourages businesses to invest, hire, and expand. Over time, this can support employment and wage growth. However, if rate cuts are driven by economic slowdown, job growth may lag. For workers, this creates mixed signals: opportunity paired with uncertainty. Career stability and skill development remain important regardless of rate policy. Inflation plays a central role in how rate cuts affect purchasing power. If inflation remains under control, lower rates can improve affordability. But if inflation resurges, savings lose value faster. That balance is why the Fed moves cautiously. Consumers should watch both inflation trends and interest rates when making big financial decisions. Small businesses are particularly sensitive to rate changes. Lower borrowing costs can help with cash flow, expansion, and hiring. Entrepreneurs may find it easier to secure loans or lines of credit. However, banks may still tighten lending standards if economic risks remain. A rate cut alone doesn't guarantee easy credit. Housing markets often react strongly to rate cuts. Lower mortgage rates can increase buyer demand and support home prices. This benefits existing homeowners but can make affordability harder for first-time buyers if prices rise faster than incomes. Understanding local market conditions matters more than national averages. For everyday budgeting, rate cuts may feel subtle, grocery bills won't drop overnight, and rent won't instantly fall. The impact shows up slowly, through loan payments, investment returns, and job stability. That's why patience is essential. Financial decisions should be based on long-term trends, not short-term excitement. It's also important to avoid emotional reactions. Some people rush into investments or debt when rates fall, others panic a boo. Savings returns. Neither extreme is helpful. Balanced planning, adjusting gradually rather than drastically, leads to better outcomes during shifting monetary policy. A Fed rate cut is not a personal financial solution. It's a macroeconomic tool. It creates opportunities, but only for those who understand how to use them wisely. Reviewing debt, savings, and investment strategies after a rate cut is a smart move. Small adjustments can compound into meaningful benefits over time. Staying informed is crucial. Rate cycles change, and today's cut could be followed by future pauses or increases. Flexibility matters more than predictions. Financial resilience comes from preparation, diversification, and disciplined decision-making, not guessing the Fed's next move. In the end, a Fed rate cut reshapes the financial landscape, but it doesn't determine your outcome. How you respond matters most. Whether you're borrowing, saving, investing, or planning for retirement, understanding the implications allows you to protect and grow your money with confidence in an uncertain economy.